everything is working. And now I should be live. So, let me know if you can hear everything. And yeah, today FOMC meeting and very important day. We will talk about what the Fed or what Jerome Powell is saying. Before it starts, I think he will push the market a little bit to the downside, but obviously he can push it as well to the upside. But just what we see in the economy, it doesn't make sense that he wants that the S&P and the economy is, or the risk assets going higher as well. Yeah, so overall, what did we got already? So far, we got a 25 basis point change in the federal funds rate. Interesting as well is what the FOMC, what the statement was, and you see that here recent indicators points to modest growth in spending and production. Okay. Job gains have been robust in recent months and the unemployment rate has been remained low, which are good indications. Unless the unemployment rate is still low, they want to have it higher because we have inflation cost of the employees. So inflation has eased somewhat but remains elevated. And then they talk about the Russian war against Ukraine. It's causing tremendous human and economic hardship, and it's contributing to elevated global uncertainty. The committee is highly attentive to inflation risk, of course. So overall, interesting things. But now let's see what the Fed is saying.
Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is...
Okay, interesting. So he is saying, that's why you see the dump right now in the market as well. And you see that here, that the interest rates are ongoing for the next meetings until they went over the level from the what's it called, for the inflation. So that's interesting.
Sufficiently restrictive to return inflation to 2% over time.
Okay.
In addition, we are continuing the process of significantly reducing the size of our balance sheet.
Interesting as well. Okay, that's nice as well. I mean, nice in case if you for the short. They are increasing as well the balance sheet. Decreasing the balance sheet. If I misunderstood that, let me check it again.
The tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
Okay.
In addition, we are continuing the process of significantly reducing the size of our balance sheet.
That's what I was talking about, okay.
Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates.
Yeah.
Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency.
Okay.
Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5% to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year.
I mean,
We continue to
right now he's
anticipate
not
that
talking
ongoing increases in the
something
target range for
special,
the
it's
federal
just
funds
that he
rate will
said
be appropriate in order to
they
attain a
might
stance of monetary policy that
still
is
going higher
sufficiently
with the
restrictive
interest rate, but
to
if they're
return
doing
inflation
it,
to
it's
2%
another
over
story.
time.
And that they
We are seeing the effects of our
increase
policy
their
actions on
balance
demand
sheet.
in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. Shifting to a slower pace will better allow the committee to assess the economy's progress toward our goals as we determine the extent of future increases that will be required to attain a sufficiently restrictive stance. We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is
overall,
essential.
I would say there's nothing special what he says. Just overall, he says there's still work to do in the coming months to get inflation back down. But he is agreeing as well that inflation already came down from the highest level. But overall, let's see the questions.
A deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains have been fixed, demand is shifting back to services, and shortages have been abated. So you see that in the housing services sector. We expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called non-housing services, core non-housing services, where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions. Go ahead.
Has your expectation for where the unemployment rate might go changed?
This question was actually really good. The question was if the how does he feel confident about that the inflation is going down and the unemployment rate is at history low levels. And he said his explanation was that the inflation went down because of supply chain as all stuff got fixed. But he's kind of happy still about that the unemployment rate, the labor market is still down.
Coincided with slowdown in wage inflation. Do you believe that openings are an important indicator to be studying to understand where the labor market is and where wage inflation might be heading?
So you're right about the data, of course. What we've seen average hourly earnings and now the employment cost index abating a little bit, still off of their highs of 6 months ago and more, but still at levels that are fairly elevated. The job openings number in JOLTS has been quite volatile recently, and I did see that it moved back up this morning. I do think that it's probably an important indicator. The ratio, I guess, is back up to 1.9 job openings to unemployed people who are looking for work. So it's an indicator, but nonetheless, you're right. We do see wages moving down. If you look across the rest of the labor market, you still see very high payroll job creation, and quits are still at an elevated level. So by many indicators, the job market is still very strong.
Colby and then Howard. Thank you. Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be, and that's obviously back in December, and the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain.
Okay, here he said as well that they still think on going for 5.2% in interest rates. So they're still growing.
We still think there's work to do there.
The interest rates,
a decision on
and there's still work to do something against inflation, but overall it sounds more bullish than, because this was already expected, right? Because we priced already that in, but it gives the market more kind of soft zones.
That we need to write down to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in the other direction, then we'll make data-dependent decisions at coming meetings, of course.
Just as a quick follow-up, how are you viewing the kind of balance of risk between those two options of, the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close.
Okay, S&P is going higher, and as you see here, DXY is closing now, or is going below the 101 level where I wanted to see the market.
Of course, we have no incentive and no desire to over-tighten, but we
will talk later about that after.
We can certainly, and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in core services ex housing is still running at 4% on a 6 and 12-month basis. So there's nothing happening there. In the other two sectors, representing less than 50%, you actually, I think, now have a story that is credible, that's coming together. Although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So for the third sector, we don't see anything here. So I think it would be premature. It would be very premature to declare victory or to think that we've really got this. We need to see. Our goal, of course, is to bring inflation down. And how do we get that done? There are many factors driving inflation in that sector, and they should be coming into play to have inflation, the disinflationary process, begin in that sector. But so far, we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
Okay. Yeah, he just said the same like before. He's really good in talking, actually. He just said the same before that there's a lot of work to do to get inflation down, and we will see later as well the problem of the inflation because it's not already there. And but there's a lot of work to do to beat up the high of the inflation.
The prices were being driven higher. Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
So I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far. Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening, and for the reasons we thought. It's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. This is a good thing. But that's around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And we, as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then
okay,
come
that's
down,
interesting. He's checking the housing services.
That new leases continue to be soft, and we do assume that. So we think that that's sort of in the pipeline, and we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down, this is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods the core services ex-housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same, and we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that is research would show is sensitive to slack in the economy, and so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet, and I think we need to see that it's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's not that we're neither optimistic nor pessimistic. We're just telling you that we don't see inflation moving down yet in that large sector. I think we will fairly soon, but we don't see it yet. Until we do, I think we see ourselves, we got to be honest with ourselves, we see ourselves as having perhaps more persistent, we'll see, more persistent inflation in that sector, which will take longer to get down. And we're just going to have to, we have to complete the job. I mean, that's what we're here for.
Nick Timmeros, the Wall Street Journal. Chair Powell, you observed several years ago that we learned we can have a low unemployment rate without above target inflation, and we have learned lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
So we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is, to ourselves, and the way we understand it is basically the three things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, right, by an appropriate set of measures, are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
You'll see the minutes will come out in 3 weeks, and we'll give you a lot of detail. We spent a lot of time talking about the path ahead and the state of the economy, and I wouldn't want to start to describe all the details there, but that was the sense of the discussion, was really talking quite a bit about the path forward.
Victoria.
Hi, Chair Powell. I wanted to ask about the debt ceiling. Given that we've now hit up against it, I was wondering if the U.S. goes past the X date, will the Fed do whatever the Treasury directs as it relates to making payments as the fiscal agent, or will it do its own analysis of any legal constraints?
So your question is, say your question again?
Will the Fed do what Treasury directs as it relates to making payments, or will it do its own analysis of any legal constraints?
So you're really asking about, you're asking about prioritization, in effect, is what
Yes,
you're, okay.
yes.
So I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And
actually, how he is overall talking,
and that no one should assume that the Fed can protect
it
the
looks
economy
really
from
positive
consequences
for the
of
market,
failing
and
to
I
act in a
mean
timely
we
manner.
see that.
In terms of our
We see
relationship
that
with the
here,
Treasury,
and
we are
there's
their
all
fiscal
times
agent.
one thing:
And
never
I'm just
trade
gonna leave it at
against
that.
the Fed.
Are you actively
Right,
doing any planning of what might happen in the event that would happen?
But
I'm
actually,
just gonna leave it at that. This is a matter that's to be resolved between.
I mean, if he's saying
really,
he's not
it's really
looking
Congress's
at
job to raise the
overall
debt
about
ceiling,
the unemployment
and,
rate,
I
and he's
gather
happy
there are
about the
discussions happening,
unemployment
but they
rate,
don't involve
and
us.
he's
We're
looking
not,
more to the housing
we're not
markets.
involved in those discussions, so we're the fiscal agent.
And there, the inflation is still not down.
Gina and then Steve.
Gina Smiley from the New York Times. Thanks for taking our questions. I wonder, was there any discussion today of the possibility of pausing rate increases and then restarting them? Lori Logan from the Federal Reserve Bank of Dallas seemed to suggest that that would be a possibility in a recent speech, and I wonder if that view is broadly shared on the committee.
So, the committee, obviously, did not see this as a time to pause. we judged that the appropriate thing to do at this meeting was to raise the federal funds rate by 25 basis points, and we said that we continue to anticipate that ongoing increases in the target range will be appropriate in order to attain that stance of sufficiently restrictive monetary policy that will bring inflation down to 2%. So that's the judgment that we made. We're gonna write down new forecasts in March, and we'll certainly be looking at the incoming data as everyone else will.
Sorry, I should have been clear. I mean, would it be possible to take a meeting off, for example, and then resume? Could you, rather than just doing at every meeting a move, go a little bit more slowly, take some gaps in between moves?
I mean, I think this is not something that the committee is thinking about or exploring in any kind of detail. In principle, though, we used to do was go every other meeting, if you remember, 25 basis points, and that was considered a fast pace. So I think a lot of options are available, and I mean, you saw what the Bank of Canada did, and they left it that they're willing to raise rates after pausing. But this is not something that the Federal Open Market Committee is on the point of deciding right now.
Steve Leisman, CNBC. Mr. Chairman, the SEP has the PCE inflation rate in 2023 at 3.1%. Meanwhile, the 3-month annualized PCE is 2.1%, and you've achieved this without going to your 5.1% funds rate, which is what you have penciled in for this year. And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year. I'm wondering if you've considered the idea of whether or not your understanding of the inflation dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without the surge in unemployment. And specifically, I wonder if you might comment on the speech given by Vice Chair Lel Brainerd, who said, to the extent that inputs other than wages may be responsible in part for important price increases for some non-housing services, an unwinding of these factors. In other words, it may not be wages, the idea that it may not require unemployment rising to get this sector of inflation under control. Thanks.
So a couple things. First, on the forecast, if you're right, if you take very short-term, three-month, say, measures of PCE, core PCE inflation, they're quite low right now, but that's because that's driven by significantly negative readings from goods inflation. Most forecasters would think that the significantly negative readings will be transitory, and that goods inflation will move up fairly soon back up to its longer run trend of something around 0, something like that. So a lot of forecasts would call for core PCE to go back up to 4% by the middle of the year, for example. So that's really where the sustainable level is more like at 4%. So that would suggest there's
okay, I guess to be fair, there will be nothing special, nothing new what he's gonna say. Overall, he still gave as well about how he's talking, how he's standing, the feeling that everything is under control and they know what to do, and they're still looking for increasing, but it's not necessary that they're increasing. And let's talk about the charting, because we see a lot of pumps right now and we saw some targets already hit it. So we see here in the dollar index, we crossed below this low, and now the target was at 101. We're nearly there, but actually he can already return to his level, or he can return higher right now. The only thing what I wanted the whole time was that we going into this level, because we had to go into this level before we going up. So this is nice. So now we are into this one. Targets for might reversal are this levels here. And yeah, and obviously then we could see as well the reversal in the market again. But if we're looking to the S&P And this was actually not what I predicted. I predicted a red week, actually. But I mean, we still have 2 days left. But we just broke above this high again. Which is just remaining bullish again. So we will have to wait again, obviously, at the end of the day. But it was a nice breakout, retest of this trend line, and then going further up. But overall, I still think that they're going to increase the interest rates until we see unemployment rate is going higher. Because as he said that as well, unemployment rate is just really high and labor market is good. So why not increasing to get even faster to the downside? If we're checking as well this one, government 2-year yields against the Fed yields, and it never happened that the Fed funds went above the 2-year yields. So, and it's nearly here that we see the stop of the rising of interest rates. So it never happened that the interest rate went higher than the 2 years yields from the US, which is important as well to know, because as we all know, as soon as we are pivoting, we might see the crash, and every time when we increasing the interest rates, we see a pump in the market. So everything what we see is casual, it's normal. But obviously, for myself, not to that extent to the upside. And overall, you just see S&P is going higher. We just said as well, if the market is going down below this level, market can reverse to this order block here right now. So this is where the next stack could return. Then the VIX, the volatility index, is on the 2018 trend line. He still has a little left to the downside. But overall, there's really not much left for big moves to the upside. But again, I think if we analyze that right now on BTC, I still think because the news was just positive, and if the news we get tomorrow and after tomorrow are not negative, we should see the break of this high. So we should come back on BTC to 25,000 and then reverse. But again, every time what I said is something like that is not allowed to be there. The same like this one. This kind of voids shouldn't be in the market after that. So normally you have to take, or the market has to take them out. But all times the question when, right? We never know that. If we checking how fast he can go up, you see he can even go to 27,000. Yeah, this is what I wrote as well in the newsletter, what I send out every Sunday. 27,000 is a good mark for BTC. But overall, I think 25,000 should be there if we get, again, the close above 24,000. If we get the close above 24,000, then 25,000 should be in. And yeah, then I still think we need something. If there's not coming anything from the economy, and the economy is really good and we got a soft landing, I mean, then we could see new highs. There's no reason why, right? If the economy is fine, the only thing which could cause problems could be DCG. But I still don't think that we see that. So yeah, overall it will be very important what we see on Friday when we get the unemployment rate and the NFP data. Then we have more hints as well. And yeah, conclusion from the call, I think he already said, I guess he because you have to deeply analyze it. I think he already analyzed that what everyone else was already expecting. But I guess a lot of people made a bet that this week will be really bad and we see some really bad moves to the downside. And yeah, it just not happened because people expected like really bad words from Jerome, like, fuck's sake guys, don't expecting that we cut anything. We going still straight forward because market's still not good, high inflation and all the stuff. But actually he didn't do that. That what he said was already what we knew, and as well what priced in was 5%, 5.25% in the interest rates. That was the latest votes from the FOMC was showing us. So there was nothing special new, and that's why the market react bullish on that. Because obviously they expected something bad, the bad doesn't happen, so something good is happening and the market is pushing up. The question will be just how is this week ending? This is the only question. The Nasdaq, as you see, are going even higher. The only thing what I'm concerning is, look where the dollar index coming back. The dollar index coming back to the points of April 2022. If we're checking that to BTC, April 2022, normally the BTC must be there. Because, of course, you're calculating every time the dollar, as the BTC against the dollar, and if the dollar doing so much bad, then we see as well that the other doing bad as well, right? Like BTC did bad as well against the dollar. And we had to see that as well and we see that there. Look, if you're checking the euro, let's check the euro real quick. We might be there from last year April, right? Because if you're counting something against the dollar and dollar is going to the levels from April, then obviously you it must be on the same level, right? If the one retraced 40%, then you normally have to retrace 40% as well, unless BTC is as well not doing great. And that's what you see, because what you miss is to April was this one. So you miss kind of 60% what the dollar index was doing. So yeah, overall, crazy, like there was no volatility and there's still not much volatility. I think it's the lowest volatility we saw. But yeah, everything is pumping up, and we will see what's going on tomorrow with the interest rate change, and then moreover what's coming on Friday. So yeah, it was nice to do that live for you guys. I hope you enjoyed it. And yeah, I'm sorry for the mistake. I just got the message that I just had overall my face cam on and not the screen for the first 10 minutes. I'm sorry for that, but I still hope you enjoyed it, and have a great day.